For more on what's happening on the markets, joining us now is Dan Deming, Managing Director of KKM Financial. Dan, thanks so much for making time today.
Thanks, Jacqueline.
Not much of a blockbuster day on markets, but it is kind of interesting because we are in the start, at least, of earnings season. What will you be watching out for in particular?
Well, I think the guidance moving forward, overall, the numbers have been pretty positive. I think it's an 82% beat rate at this moment. And we got, 10% of the S&P reporting this week, I think 50 names or so. So, overall, the response has been fairly positive. I mean, to some degree, a mixed bag. The markets are holding just off the highs, though, over the last 6 to 8 months. So even though today was not that exciting, as you pointed out, the fact that we did come off the lows and pretty much grind back up to unchanged, I think from a short-term perspective is a positive as we are moving through expiration week here in the U.S. and also earnings will continue to unfold here in the coming days that will probably influence the price action within the markets.
I recall at the beginning of the year, so many people saying, prepare for more volatility. And we have sort of seen that so far because there's been some, fairly large ups and downs. But actual volatility right now, you've noted, is fairly low.
Yeah, it's very low from a cyclical standpoint. Yeah, we're looking at a VIX right around 16.25 right now. That's the lowest level for the VIX index going back to December of 2021. So basically, this entire upheaval that we realized through 2022 is now being priced out of the market. And there's a couple reasons for that, I think, Jacqueline. Number one, we're getting some clarity from the Fed that they're closer to the end of the tightening cycle. We'll probably get one more, but after that, they'll most likely be on hold. Now, the market's not pricing that in at the end of the year. They're still pricing in some cuts. But nonetheless, there is a bit more clarity moving through this year as far as interest rates at this point. Also, realized volatility, that's what the market has moved over the last 10 days, is at about 8.5%. With the VIX at 16, we're still not even nearly realizing what the market's pricing in the last 10 days, let alone the last 30 days, which is what the VIX looks at in the future. So the dynamics within the volatility space have come in quite a bit here in the last month or so, and that's putting pressure on the options market. And it's also providing, I think, some clarity in the market. And that's why you're seeing options traders not so aggressively purchasing either risk mitigation or at-the-money options.
Interesting, too, to see the change in message from some companies when it comes to, jobs, seeing job cuts happening. Meta, Disney were two of them today talking about those job cuts that they're rolling out. What do you make of that? Some of these, growth companies that did really pad their workforces over the past year or so, now turning things around a bit.
They are. And, I think, there's a couple things here, Jacqueline. Number one, that's what the Fed was looking for. We had a very tight labor market. It's still fairly tight from a historical perspective, but you're starting to see some of the measures that the Fed has taken over the last year, starting to be priced into the market or actually taking hold, I guess, within the market, where you're seeing some, these larger names and companies starting to impose layoffs because for cost-cutting measures, and the margins are getting squeezed due to some of the other dynamics. And so this is just a natural progression, I think, of what has been unfolding over the last year. So at this point, I don't think it's too significant. The Fed is certainly walking a tightrope, and they know it, I think. And so, it'd be interesting to see how this unfolds over the next 6 months. But at this point, I think it's viewed as more of a cost-cutting measure and ultimately beneficial for these companies as opposed to a detriment and an indication of weakness moving forward.
I'm curious to get your thoughts on Tesla as well, because we are just seeing Tesla's results come out. I'll tell you a bit about what we're seeing here. First quarter adjusted earnings per share coming in just a touch below estimates, 85 cents versus the estimate of 86 cents. First quarter revenue also just a hair below 23.33 billion versus 23.35 billion. So just a touch. But the first quarter gross margin came in at 19.3% versus the estimate, which was 21.2%. 1%. So a miss there on gross margin. Interesting, because we have heard from Tesla about cutting prices, right, several times this year. And I've really wondered if that's a sign of strength, that it wants to, it's able to do this, and maybe investors will allow them to do this. We'll see about the reaction, in order to remain a leader in the EV space, or if it ends up being, a sign of weakness. It needs these orders and whatnot. What's your take on Tesla, Dan?
Yeah, I think you kind of, fleshed it out, that there is a great deal of uncertainty moving forward. I'm actually trying to bring it up right now. I wanted to see what the reaction is in the aftermarket, but I haven't had a chance to get it on my screens yet. But nonetheless, I would suspect that possibly it's lower, but I don't know that for a fact. But
I think we are seeing it down. Yeah.
What's that?
I think we are seeing it down. Yeah.
Yeah. So I think within the dynamics of what you mentioned, I think, it's becoming a much more competitive space. And, and Tesla's, and Elon Musk is realizing this. They got a big head start. And I think that head start will continue to benefit them from a long-term perspective. And I think he's in a position now, or I should say Tesla, is in a position to offer these cost cuts and start to squeeze margins on some of these other upstarts and see how they survive. So I think short term, it's probably going to be a bumpy road. There's going to be some uncertainty surrounding the dynamics from a profitability standpoint. But I do think that the steps that they're taking are going to benefit them longer term. And the one thing about this industry, if you look at, the stalwarts in the industry over the last 50 years, it's about getting ahead of the market. And from the EV space, you'd have to say Tesla's still ahead of the market.
Yeah, what kind of pressure do you think Tesla is putting on its competitors to, catch up, but also to do it in a pretty short timeline if, there is such a push toward electric vehicles by governments? I'm thinking of the Canadian government, but also the U.S. as well. If they want people driving electric vehicles, those companies likely want to, get up to speed in time to do that.
Absolutely. Yeah. And you're seeing it starting to take hold in Ford, GM, to name a couple that, have really made a push now because the writing's on the wall. And, and they have the capability to, again, because of where they're coming from in the auto industry, to scale that into their business and produce and distribute at a significant elevated scale relative to some of these other startups. So there's going to be some consolidation, I think, Jacqueline, in the next couple of years. The speed of the evolution, I think, is going to be faster than any of us ever imagined. It's already starting to take hold, and I think it's only going to be much more of an integrated part of our transportation system in the next 2 years, let alone year. So, but I think there's going to be opportunities here. There's a lot of opportunities. There's going to be some consolidation. There's going to be some fallout. We did see the first wave of fallout in early 2022 with a lot of these companies going under that didn't have the leverage or the ability to withstand the selling pressure that the market experienced. So I think the ones that are still hanging in there, will either be consolidated or potentially fall out as well because of the dynamics of how the bigger names are starting to really take hold in the EV space.